Right. Hello, everyone. It is Janne Muta, your Chief Market Analyst here at Hot Forex, joining you for the next 45 minutes. And it is really my pleasure to spend this time with you studying the markets, understanding more on price action, the different kinds of analysis methods, and I'm really focusing on how to overcome divergence challenges. There are challenges. I mean, a lot of time when you look at the videos that teach analysis on oscillators and talk about divergences, oftentimes you find that they are concentrating on, that their efforts are focusing on occasions when everything works really smoothly and nicely. But, I mean, anyone who's been trading knows that that's not real life. Real life doesn't work like that. There are occasions that you can see beautiful divergences in different time frames, and then it doesn't work. The price still keeps on going, and it doesn't reverse. Okay, so today I'm going to focus on those occasions that it quite doesn't work out, and you need to find ways to actually understand more about the price action at those moments, and then trade accordingly. A very brief background on myself. I started in this business in 1998. I'm originally from Finland. I've been working in both Helsinki and London for institutions as a fund manager, a trader, a market analyst. And now here at Hot Forex, it is my sort of goal to help the traders to learn more, to understand more about markets so that they can grow and become more confident in their trading. Because at the end of the day, there is no way to be confident if you don't understand enough. At least that's my experience. Now, briefly, just in case you have audio or visual issues during this live broadcast, please check the settings on your computer or device, and if you still have problems, let the webinar moderator know, and she'll be happy to help you out. As we're dealing with stuff that has risk associated with it, let's take a minute and read through the disclaimer. This material is provided as a general marketing communication for information purposes only and does not constitute independent investment research. Nothing in this communication contains or should be considered as investment advice or an investment recommendation or a solicitation for the purpose of buying or selling of any financial instrument. All information provided is gathered from reputable sources, and any information containing an indication of past performance is not a guarantee or reliable indicator of future performance. Users acknowledge that any investment in FX and CFD products is characterized by a certain degree of uncertainty, and that any investment of this nature involves a high level of risk for which the users are solely responsible and liable. We assume no liability for any loss arising from any investment made based on the information provided in this communication. Okay. Now, in today's webinar, you will be learning about divergence basics. Obviously, there are people here in the audience who've been trading for quite a few years and might find listening to basics kind of a bit of challenging, but you know, you have to sort of try to just take a cup of coffee or something while we go through the basics, because there are people who are new to this business and they need to have an opportunity to learn about basic things. Okay, then we take a look at the RSI and MACD oscillators. I've chosen these two just for the purpose of showing you how oscillators can be very different, and they have different characteristics, and therefore we need to understand those and integrate these things into our analysis. Then, what causes the divergence to appear? I mean, that's a really good question, because too often traders just take things granted. They think that if you see something happening in the marketplace, yes, it's just going to happen because for some X, Y, Z reasons, it just happens. No, there are reasons behind everything. And what causes divergences to appear, there are reasons in, obviously, the formula that the indicator is based on, but then there are reasons in the markets, in the price history, and we're going to learn about those too. Okay, then we'll learn about limitations with RSI and MACD, especially when doing the divergence analysis. There are limitations and we need to understand those. By the way, while I go through this, would you be kind and type in the questions, Q&A window or chat window or whatever. Tell me where you're from, how long you've been trading, and, you know, that would give me an idea of who you are. And, you know, it's nice to know who you're talking to. And obviously, I get a bit of idea on how experienced you are as well. Then I'm going to give you some tools for filtering out failed divergences. We're going to look at Bollinger Bands, price formations such as wedges and channels, and then also support and resistance levels. And last but not least, we're going to take a look at how to trade divergences. Excellent. I'm getting some messages coming through. Yes, welcome Singapore. 2 years of experience. Very, very good. Anybody else out there? Northern Carolina, welcome. 4 years. Very good. Very good. I'm going to move on while the others are still typing where they're from, etc. Still on the basics. We need to understand basic vocabulary in order to know what we're talking about. You know, those of you that have been trading 4 years, 2 years, etc. You probably know all this already, but just so that the newcomers get on board as well. So, oscillator is an indicator that oscillates or moves up and down with price, and then it measures momentum. These can be stochastics, relative strength index, money flow index, MACD. There are loads of others, of course, but you know, didn't see a point to list everything here. Then, momentum. What's momentum about? If price is moving fast over a short period of time, then we can say that the momentum is strong. It can be upside or downside momentum, of course. And if the price movement slows down, then we say that the momentum is slowing down. It takes more time for price to cover a certain distance. It's like if you ever tried running up up the stairs in a building that has a lot of floors, like the building that we have our offices in. I'm on the 9th floor, and sometimes I walk up the stairs or run up the stairs, and there's a lot of momentum in the beginning because I have still strength, yeah, but, you know, after 4 or 5 floors, it's getting heavy, and I have to take more time to cover more steps. So that's what momentum is all about. That happens with the price as well. At some stage, the fast movement slows down, and it takes more time for price to cover the distance. Then divergence, an indicator moving in different direction to the price. Sometimes divergence is a little bit difficult word. You know, I come from Finland originally, so it is sometimes difficult for me to understand English words or find the right words. But, you know, divergence was one of those big words loads of years ago. many years ago. But, you know, it's basically, it means that there's one moving away from the other. Positive divergence indicator moves higher while price moves lower, and negative divergence indicator moves lower while the price is still making higher highs. And I'm going to show you some examples soon, just to cover the basics. If I don't speak clearly enough, please let me know, because I can see that there are people from countries that don't have English language as the first language. So, you know, if I'm not very clear in how I speak, let me know, and I try to slow down. All right, negative and positive divergence. If a price makes higher high, while the oscillator makes a lower high, then we have negative divergence. Here in the point A, we have price moving higher than before, and the oscillator moves higher, so it makes a higher high. But then in points B and C, we have higher prices, higher highs in the price, but then oscillator makes lower highs. Negative divergence, yes, and the same the other way around. Price makes a lower low, while the oscillator makes a higher low. That's positive divergence. So in point A, we have lower low in price, lower low in oscillator, but in points B and C, we have basically lower lows against higher lows in oscillator. Yeah, and then in the pictures. Here's a chart. Here's the pound USD weekly chart. What's happening here? What's happening here? When the price is still making lower lows, but the RSI is making higher lows. What does it tell us about the market over here? And why is the divergence happening here? Can somebody give me ideas why the divergence happens over there? You can type your answers in the chat window. Why do we have divergence here on this indicator? I'd love to see some answers. Yes, RSI is moving higher, so that means there is divergence. But why is it happening? Can somebody tell me why is RSI moving higher while the price moves lower? What's the reason for it? Yeah, that's a good one. Buyers are coming in. Yes, buyers are impacting the price action, and that causes the RSI do something. It causes the RSI to move higher. Yes, that's part of the answer. Okay, I'll help you a bit. Basically, one of the answers is that at this point here, we have different price action to what we saw earlier. If you see, there are a lot of red bars, a lot of red candles here, then one green candle. A lot of red candles and another green candle. Yes, we could say we probably have market oversold, but it was oversold here as well. Then according to RSI 14 periods, it was oversold there as well. Maybe Draghi or Yellen were speaking. Yeah, that could have been. That could have been. But what I'm seeing here, I was telling you that there are a lot of red bars and only few green bars or candles there. But what we're seeing here, we have a rally higher for 3 weeks of green bars, then a down move, and then the balance of greens and reds is kind of almost even there. Kate Carlos is saying, are you asking for the technical function of the indicator or what is actually taking place on the market? I'm actually asking both. I'm actually looking at the both things here because we need to understand not only the technical function, but we also need to understand what is taking place on the marketplace. And, you know, one of the answers is that, yes, we are seeing bigger rallies than ever before here on this period. So therefore, RSI is moving higher. So one of my points is that you don't really need the indicator to tell you that something's happening there. I mean, too often, traders are very focused on indicators and forget about what else is going on there. You need to have the thorough understanding of the marketplace. But also, if you take a longer term view on the price history, in the occasions like this, when the price starts to react, yeah, the selling, Peter is saying that the selling pressure is weakening. Yes, that is very true. But if you take a very long-term view and see what's else there in the price history, I don't have a chart for you, but you can take your pound USD chart and look at what's there on the left. Go there and you find that there are potential support levels there that impact how people start thinking about this market. Then they see that the downside is getting limited. If you come to hotforex.com and you download my sort of a bigger trends, 2015 trends document, you can see what I was talking about there, but basically you can see that also on the charts. Now the same thing here. We have higher prices in pound, and at the same time, oscillator is making a lower high. So momentum is slowing down, and you get some other signals too there that, yes, like a shooting star there, that the momentum is really fading. Okay, but because the time's limited, I'm going to rush on. Now, understanding oscillators and divergence. RSI divergence. Okay, how does it happen? Sometimes it's a little bit difficult to understand what is happening with the indicator and why is it happening from the formula itself. I could have shown you RSI formula, but instead I'm going to sort of condense the formula into this statement here. RSI moves higher when the size of up candles increases more than the size of down candles over the 14 candle look back period. So if you're using RSI 14, you obviously take into calculation the latest 14 candles, but you might as well use 7 periods or 21, whatever. But the point here is, if you look at these 14 periods that I've highlighted here, there's a lot more green than red over this period. So you get more upside movement, and that's why RSI moves higher pretty quickly. But then on the next occasion, here, when the price makes a high with a higher high, with less green in relation to the red than in the previous occasion, then we have a higher high, we have a lower high in the oscillator, even though the price makes a higher high. So, yeah, that's basically simply how RSI creates the highs and lows. Now we have some problems with this. Limitations of RSI divergence. Basically, first of all, limitations with the RSI indicator itself. Because RSI is a bound indicator. It cannot move to values above 100 or below 0. It just cannot go there. Which basically means that if RSI is at or near these extremes, the next price high or price low is very likely to create a divergence indication in the RSI. So let's imagine this level here, it's now at 75, but if this was 99, 98, or 100, then whatever the price does after this point, RSI cannot move higher, but it will create a lower high at some stage. So therefore, even the price moves higher, RSI creates a lower high, but that's only because the own functionality of RSI. There's zero validity or information for traders in that indicator there. Also, there's no logical reason why the amount of up movement over the last 14 candles alone would always have the same indication on price action. I mean, if you've been following the markets long enough, you know that when price starts to move from bottoming formation, there's a lot of movement there. And if you grab 114 periods sample there, and then take another 14 periods movement and RSI sort of indications from, at a later stage when price is already approaching a resistance level, for instance. Those 14 period movements, they cannot have the same interpretation on all of the occasions. You have to take into account the context that the price action is happening in, where it is taking place. So, as a conclusion, RSI divergence needs other methods of analysis to support it and filter out the wrong signals. Okay, let's move on. That's why I'm introducing also MACD or MACD. Just quickly, what this indicator is about. It's about the difference between two moving averages, pretty short-term moving averages, 12 and 26. They are EMAs, exponential moving averages, and I've plotted them here on the chart. The red line is 12, the blue line is 26. Now, MACD line, the blue MACD line here. This is, I'm getting a message that the sound might be cracking a bit. Maybe this helps. Okay, let's see. Let me know if it's better now. Very good, very good. Okay, now, the blue MACD line here. It moves higher when, in these two occasions, when A, the 12 EMA is below the 26 EMA, and the EMAs are converging, i.e., the difference between them is getting smaller. Then, point B, EMA, the 12 EMA, the faster EMA, can be, and it is above the slower one, from this point onwards, and if the EMAs diverge, in other words, if the difference between them is growing, then the MACD line will keep on moving higher. But as soon as this increase doesn't happen anymore, when the moving averages start to move closer to each other, the MACD line turns lower. So, if MACD line makes a lower high, like here, then it means that the distance between the moving averages here didn't increase as much as just before the previous price peak. Here's the peak one, and as you can see, price rocketed higher, and the difference between those two moving averages increased quickly. So MACD went up quickly. Then the next one, just before this high here, there wasn't much increase in the distance between them, just a little bit there. And that's why we got a lower high. Now, MACD divergence benefit over the RSI is basically the fact that MACD is not a bound indicator. It can create new highs and new lows without limitation. There's no limitation to how low or how high MACD line can go. So obviously that is a benefit over the RSI. But even then, even though MACD is not a bound indicator, it's still, the observations based on it are still quite limited. They are limited to a short period of time because this faster moving average, 12-period moving average, is responsible for most of the movement in the indicator, in the MACD line. So what you're doing here, if you only focus on MACD making lower or higher highs, you're only focusing on previous 12 bars here and previous 12 bars here, and maybe something in between, but that is a too narrow view on the market. There are thousands of data points that we ignore if we do this. Obviously, I'm not saying we need to take all that in, but I'm saying that we need to have a wider understanding. So we need some other tools as well. So before we go and take a look at other ways to study momentum, I'll grab something to drink here very quickly. I'll be back with you. Just a moment, please. Okay, here we go. Bollinger Bands. Now, on this picture, you can see that the MACD is making lower lows, while price keeps on moving higher. Now, my question to you is, what's the difference in these numbered points? If you look at the price actions there, and if you look at the Bollinger Bands, what is the major difference between points 1, 2, 3, and 4? What's the difference? If you can spot the difference, very good, because that tells me that you are very observant. That tells me you can sort of grasp things very quickly. Okay, bands getting smaller. Yes, they are getting closer to each other. That's a good observation, but I'm actually focusing on something else. Something that tells you about momentum. Remember what I told you about me running up those stairs on in this 9-story, 11-story building? Okay. First of all, there's a lot of momentum. Yes, size of bull candles is a good answer, but I'm focusing on the Bollinger Bands and how much price action is taking place outside the Bollinger Bands. Because when the momentum is strong, price is more likely to stay outside the upper Bollinger Bands, right? 3 candles almost outside the bands. Then we have one candle outside the bands. Then we have just one close and a couple of high values. And then on 4th point, we have only the spikes outside the upper Bollinger Band. Okay, that tells you that the momentum is slowing down. It basically confirms the message that we get from the MACD. But as long as we see this, as long as we see a lot of momentum from these kind of swing points here, it's not likely that we have a turnaround point. And on this information only, we can't really say that now price is turning. But the fading momentum is highlighted, so it supports the analysis. It gives you a wider understanding of what's going on. Now, what happens here? It usually happens when market approaches certain historical price levels. And that leads me to a next very important point. This is one of the key takeaways from this webinar. Support and resistance levels. A level that used to be supporting price is now resistance. And these two vertical lines here, they basically define the area that we were actually looking at in the previous chart, the 60-minute chart. So, what causes the divergence to appear? I tell you, basically, the reason for divergence appearing here is that the price is approaching, the price action is happening closer and closer to this important resistance level. And the traders know that when the price is coming to a level that used to be support prices, it is now likely to be a resistance now. So traders are getting more and more careful. So here we have those vertical lines here. Here we have price moving less and less outside the Bollinger Bands, MACD making lower highs, and this is a hesitation. The reason for the divergence to appear is the hesitation of longs here. Those that are bulls are really getting very hesitant because they see this resistance there. And they know that it's not easy to push the prices through resistances. So they get more careful. And only those who don't know what they're doing, they try to buy and push the price through there. But the big guys are offloading their positions while the small guys are wondering why on earth this is so difficult. But if the small guys know what I've told you now, and they know that there are resistance levels that we need to pay attention to, and we can get more information by paying attention to divergences, moves outside the Bollinger Bands, and price formations, then the small guys can trade accordingly. Basically, in this occasion, it's the failure to penetrate the resistance and then a break below the wedge here that confirms that this MACD divergence is finally valid. Okay, now, the obvious question, and I'm trying to rush because the time's so limited, the obvious question here is how do we trade these situations? And my answer to you is multi-time frame analysis. I often agree with this MTF analysis. It's basically, if you look at the daily chart and then you look at the hourly chart, like here in this example, you've already paid attention to multiple time frames and you're already making some multi-time frame analysis. Okay, that's a question. How do you apply for buy or sell when divergence happens? And it's an excellent question because this is what I'm going to answer you now. This is how I trade these sort of situations here. When price is trading close to a resistance level and the divergence occurs, and you see something like a wedge in 60-minute time frame, then you can go to smaller time frames and see what is happening there. And sometimes you get another wedge there, which very sort of precisely points you to reversal spots. That is one of the reversals, momentum reversal signals that I usually talk about to our traders and teach in my webinars. But also, there are other kinds of signals. So what you need to understand here, that the most important thing is the price is close to a resistance level. Anything that happens there is just, close to that level is kind of a symptom of that level. So the level causes traders to get more careful, and eventually the price turns down. And now what to do? When you come here, you can go to smaller time frame charts and find kind of signals to go short at certain levels. Like here, some people call this an exhaustion candle. Some people call this a pin bar. They call this a shooting star. Whatever you decide to call this, the basic message here is that the buyers bought the price higher, but then the level wasn't sustained and the price turned lower again. This is a failure to move higher. When this happens at the Bollinger Bands or at resistance, after what you've seen happening here at a bigger time frame resistance, then that is your point to go short. I'm not saying that now you should go and start trading with this, putting in huge positions and see what happens. That is not the way to approach any new ideas. If this is a new idea to you, please go and study the price charts. See if you are convinced, as I am convinced, that this works. If you are convinced, then start integrating this into your studies and trading. But don't do it blindly. Just don't do it because I say. Do it because you've done your due diligence, because you've done your studies, and then you are convinced it works well enough. I'll tell you, there'll be occasions when the trades are stopped. There'll be always those occasions. But there's nothing that works 100% of the time. So you have to settle down for the next best, which is something that works well enough. Okay, it seems that I've exhausted my 45 minutes here. It was really great to have you in this webinar. If you want daily analysis, go to my analysis website at analysis.hotforex.com, and basically that's where I write my stuff. You can go to hotforex.com, or you can go directly to the website, and the address is analysis.hotforex.com. I'll do some multi-time frame analysis there, put some macro views there as well, but really it's about price action, and it's a kind of complete package with my webinars that you can access via hotforex.com. Lovely. Thank you for your time. Thank you for spending the 45 minutes with me. It has been great. You really did have good questions, and I look forward to seeing you again. If you did like it, please let me know. If you find that some things need to be improved, I would still like to know. I would love to hear from you. Thank you, and trade safe, and see you next time. Bye for now.